Okay, 3, 2, 1, let's jam.
What is up guys, G here back with another video. Today I want to go over DraftKings fourth quarter earnings and how this affected the stock price today. I want to give you guys my overall thoughts, the important things to take note of, and what I hope to see going forward. I also want to share with you guys an update on the short volume activity. And lastly, we'll take a look at the chart for some key levels to watch, so make sure to watch to the end. Now before we start, do me a favor and drop a big thumbs up on today's video, and subscribe to the channel if you want to see more videos like this. And with all that out of the way, let's get started with today's video. So DraftKings earnings was a bit of a mixed bag. We had some good revenue numbers, but in my opinion, what really caused some of the sell-off was the 2022 EBITDA loss forecast. So they are expecting a bigger loss this year than anticipated, and I believe that is due to investing more into its launch into the new states like New York and Louisiana, and that could even be wider if more states do get legalized this year. On the positive note though, they did get some great revenue numbers. They actually beat above the expectations, and they also raised their revenue guidance for 2022 as well. But we'll go more in depth on all that in a bit. Robbins did go on CNBC today. He said, "We have a multi-year plan. That plan goes out to 5 years, and we have certain milestones that we need to hit each year, and so far we've hit them all." Robbins was also asked about the recent share price drop after earnings. He said that the market is pretty crazy right now, but they are doing what has been consistent since day one. I think consistency is great. I just hope they don't consistently keep burning cash, because that is the main issue here. But all jokes aside, he said, "I think the model's working and we'll play the long game here." I'm very confident that once the market settles down and rationality kicks back in, then the metrics that we're putting out there will start to resonate with some people. But in the meantime, we're just going to keep doing our thing, and hopefully the market will catch on. I think that does reflect the stock price. Obviously the stock price has been overinflated, and with the recent sell-off in the market, many companies have been coming down to more of a realistic valuation. So for example, you could take a look at Roku, Zoom, Affirm, and so on. So DraftKings is not the only one that's been in a downtrend for some time now. It's really just about picking that company you believe will be able to manage through some of these hardships, and then later be able to dominate their sector, which I believe DraftKings does have that opportunity. So definitely just something to consider whether you debate on holding or selling out of your position. I think DraftKings and some of these other high growth stocks definitely need some conviction from the investor. Personally, me, I am a little bearish in the short term, but I still have my position because I think in the long term this will pay off. But I will share some of the bearish things going forward later in the video. So as I mentioned before, they did beat their Q4 revenue estimates. Last year they made $322 million for 2020, and this year they reported $473 million for the same quarter this year, which is an increase of 47%. The $473 million revenue also exceeded their previously announced guidance, which was announced back in Q3, and it beat that guidance by over 8%. From a year-to-year revenue growth, they did increase their revenue by over 100% compared to last year's revenue. According to Robbins, they far exceeded their expectations on the top and bottom line for Q4. They had an excellent quarter to cap off the year, in which 5 states were contributing positive contribution profit, which further demonstrated the effectiveness of their playbook and supports their positive view of the industry's total addressable market. So going into 2022, they're very well positioned to continue their growth market expansion, as well as optimize the user experience and continue to strengthen their multi-product suite of offerings. So that was just comparing some of the Q4 numbers from this quarter compared to last year's quarter. But moving forward with the revenue guidance for this year, they did raise their fiscal year 2022 revenue guidance from a range of 1.7 to 1.9 billion to a range of 1.85 billion to almost $2 billion. So that will equate to a year-over-year growth from 43% to about 54%. The bad part of the guidance though is that 2022 adjusted EBITDA guidance. They are expecting an EBITDA loss in 2022 between $825 to $925 million this year, versus the initial estimate of around $572 million. However, all this revenue guidance for 2022 does take into account the investments that they will make into New York, Louisiana, all that going forward to 2022. But any new states that do launch after February 18th can definitely affect the guidance, so it really just depends on how legalization of the states go this year. DraftKings also does expect to have a positive contribution profit for fiscal year of 2022, and that will be across all their states including New York and Louisiana. I think that's great news because New York is going to be one of the bigger players, so for them to be able to turn positive profit in that state is going to be huge for this year. One interesting fact that they did mention was that assuming no new states were added after December 2021, then they could have anticipated a positive EBITDA at the end of Q4 of 2022. But since they did get Louisiana and New York, that definitely did change some of their projections going into 2022. Based off of their new projections and a current legalization percent of 7 to 9 each year, then they do expect to generate a positive EBITDA by the end of the Q4 in 2023. So just 1 year later. Moving away from the guidance and all their revenue numbers, I think one of the more important metrics to definitely take a look at is their player retention, because this is where all their revenue is coming from. They want to be able to keep the player on their platform as long as they can, whether it's with different products or offerings. The key is for them to stay on the platform the longest and spend the most money possible. So DraftKings seems to be doing great in this department. Their monthly unique players increased about 32% compared to last year's quarter. On average, they had 2 million unique customers engaging with the DraftKings platform each month in the fourth quarter. So this is showing a very strong player retention. They're able to hold their customers across all their different products, whether it's the sportsbook, the iGaming offerings, and this seems to be the same case across all their new states. The average revenue for each payer was around $77 in the fourth quarter, so that is an increase of 19% versus last year. And so that's the key of the business. They're trying to get more bets on their platform, so as they start offering more products, that will definitely help get more bets on their platform. And so one of the ways that they can continue to get customers and continue engagement with them is to continue to innovate their platform. So just in the fourth quarter, they launched the parlay and the same game parlay insurance promotion capabilities, which allows bettors to win something even if they lose their legs within their parlay bet. So what this does, in my opinion, is incentivize them to bet, because they feel like even though they don't win the main bet, they can still get something on the side. But in the back end, DraftKings is still making a percentage of that. So that's going to be one way that they can continue to drive up revenue and incentivize players to keep betting. They also been expanding their platforms to not just the NFL and NBA, but they did recently launch it to the college basketball as well as the NHL. So in that perspective, they're bringing in a new fan base and offering the same amount of parlays and different product offerings. Two features that I'm very excited for is the DraftKings Social and the Dynasty Rewards. The DraftKings Social sounds really interesting. It's going to be an industry-first innovation to create an integrated social community that allows them to interact with each other. So I haven't really seen it, but I'm picturing kind of like a Discord or group chat where they can kind of talk about their bets, interact with each other. And then the conference call, Jason did say that it's going to offer Zoom and video and audio capabilities, and I believe screen share as well. So I think that's going to be a really cool feature and a way to keep the customer engaged on the platform. As far as the Dynasty Reward program, I think that's going to be a way for them to incentivize more bets, as they're going to be getting rewards and points after each bet. Haven't really read too much on this one, but that is basically what a rewards program is, but it's a way to give customers back for each bet that they place. As far as DraftKings Roadmap, they are successfully launched in New York and Louisiana, so they are now in 17 total states, and that is about 36% of the entire US population. Their iGaming sector is currently in 5 states, and that represents around 11% of the US population, so that is one that they definitely need to put more effort into. I think MGM, Caesars, and the other sportsbooks do have an advantage against DraftKings in this sector, so I do hope that they do put some effort and resources going into this year. Looking further into 2022, there are 10 state legislators who have introduced legislation for the legalization of mobile sports betting, as well as 8 that are trying to expand their existing sports betting framework. In addition, there are 3 states that have introduced iGaming legislation, and then there are 3 states that have introduced online poker legislation. So for this year, there's still an opportunity to expand. That will definitely depend on the state legislation. Right now, there's 3 states with US jurisdictions where DraftKings can potentially participate in. That is Maryland, Puerto Rico, and Ohio. They have already authorized mobile sports betting, so that will represent around 7% of the US population if they do participate in that, and that will bring up DraftKings numbers to around 43% of the US population. So tons of great stuff coming forward in 2022. I definitely recommend you take a look at the earnings report and the conference call. I also want to bring to your attention the virtual investor day that is going to be on March 3rd. So DraftKings is going to be hosting a presentation and talk about the total addressable market. They're going to give insights into the market share and product innovation that makes them different from the competition. So they're going to give us some numbers on the payback and state profitability results, as well as an update on their long-term adjusted EBITDA outlook. So that's going to be one of the major things I'm going to be looking at. If you guys are a DraftKings investor, I definitely recommend you guys check out this investor day. It's going to give us a better picture of their 2022 growth outlook, and they're also going to have a Q&A session, so hopefully some of the questions that we have are answered. So now I want to move over to some of the institutional ownership and some of the short volume activity. As you know, Kathy Wood and ARK Invest have a big position in Draftkings. Earlier this week, they did have to file a 13G form, which basically says that they are 5% or more ownership. But with Kathy Wood's 2022-2021 performance, if you guys don't have credibility for that, I would say at least have credibility with Walt Disney. As you can see, they have a 4.8% ownership in Draftkings, and they've been holding that position since last year. As for the short volume reported by FINRA on February 17th, you can see about 5 million shares were shorted, and that is from a total volume reported by FINRA of around 11 million. So the short volume ratio is around 48%. For the most part, that has been pretty consistent for February, dating back even to February 4th. The short volume ratio on average was around 46 to 50%. They also still have tons of shares available to short, about 6.7 million shares, and the short borrow fee rate is not high, about 0.42%. So in my opinion, still a big possibility for them to continue to short. I will say though, this is a pretty heavily shorted stock now. You can see the short interest percent flow is around 12.58%. Well guys, I'm going to wrap up the video by taking a look at the chart and give you guys an idea of what I see going into the next week. As you can see, we were in this ascending channel here, but we did break underneath that and we actually closed underneath our monthly level. So that could have been an indication that we could see some downside. Our RSI was actually also on the moving average, so we could have broke down, but again, we had earnings and that usually is a 50-50. In hindsight, it is easier to say we would have broke down, but you really never know with earnings. For all we know, we could have gapped up and gone up to $27. But the reality is today we did gap down to almost $18.80. And we ended up closing at $17.29, which is down almost 22% for the day. Our volume for the day was 80 million shares traded with an average of 27 million shares. So we did have tons of volume today, but unfortunately this is not the volume that we like to see. And as I showed you guys earlier, the Fintel and some of the stuff that was reported, a lot of this volume was short. So today's volume is going to come from short sellers and then also people selling out from fear. And then the rest of the volume is just people starting to add to their position. But for the day, majority of the trading day was very bearish. As you can see, we had a long red wick candle. I would have loved to see a long wick candle, but then buyers stepping in and closing close to our open. But unfortunately that did not happen. As you can see, there's definitely no buyers stepping in just yet, so there could be some people waiting to get back down here around $16, maybe even $15.50. For me personally, I did actually already add some shares here at $18.80, but now that I look at the price action, I do expect us to possibly come down and touch $16, just because we did have a nice buy zone here and I didn't really see many people step in. And again, all that can be seen from this long red candle where nobody stepped in to buy the positions. Clearing the chart a bit and zooming out, I do want to show you guys where I got this level here. Historically, this was a nice support level. It's also a monthly level here. So that is why I see this range being a nice support for us. But if we do fail to hold this level, things could get a bit ugly. We could see us coming down to around $13.40. I don't see us coming down to this level unless the market shows very strong weakness. Leading into next week, depending on how strong the indexes are, we could possibly see this level here. Or zooming back in, I do want to show you guys the next scenario here. If the indexes are strong going into Tuesday, as remember, Monday we will be closed. We could work our way back up to this level around $18. That is going to be a pretty strong resistance. But once we get past this level in $19.50, I do expect us to possibly fill this gap in. And so that would push us all the way back up to about $22.30. And so this will be a nice percentage gain here, but we first need to be able to break $19.50. So going into next week, we could either do this first scenario or the second scenario is come down to about $15.50. And if we fail to hold $15, then that can definitely get ugly for us. As you know, $15 is a psychological level. So definitely be watching the indexes and the overall market going into next week. But that is really all I see in the chart. As of right now, I am a bit of a bear just because the indexes are very weak. There's a lot of war tensions and everything else going on in the market. So I do think that this second scenario will be more likely. Not to mention that the RSI does have some room to come down, maybe down to 19, 20 points. We are currently sitting at 35 and sitting underneath the moving average. So that is all I have for the technical analysis. Let me know if I missed anything. What are you guys seeing in the short term and the long term? Long term, I am bullish on the company. I think some of the earnings did get overlooked. We had some good revenue numbers. They also upped their revenue guidance, but their operating cost and their market spending is what's really killing DraftKings, as we all know. But like I said in one of my videos, this is a very expensive sector. I haven't really looked at some of the other companies' metrics, but I believe they would probably be spending about the same amount in marketing and stuff. So that is just something that we'll have to live with in the short term if you guys want to invest in this sector. So I hope you guys enjoyed today's video. Let me know your thoughts on DraftKings in the comments below. If you found this video helpful, make sure to smash the like button, subscribe to the channel for more videos like this. I hope you guys have a great day. I will see you guys in the next video, and as always, keep moving forward.
Bye.